Hey guys, today we're going to highlight some of the original commentary and the top articles that we came across for the week of April 9th, 2021 on Validea's Guru Investor blog. So to start, Jack, I thought I'd give you the floor and you can talk about the article that you wrote on bubbles and maybe even want to highlight one of the people that read it, the feedback you got.
So I don't know about you, but I've been getting a lot of questions, because of what's been going on with the market in the post-coronavirus period. I get a lot more investing questions. People know I'm in the investing business, so I've gotten way more questions since then than I normally do. And there's been, some of the questions have been things that, obviously are just not prudent decisions, like, should I buy call options in GameStop or something like that. But I got one last week that I thought was a very thoughtful question, and the question was, are we in a bubble? And if so, what can I do about it? And, I think those are two separate questions, but two interrelated and very important questions. And so what I did with my article this week is I wanted to start by trying to define what a bubble is. And then after that, I wanted to say, well, once we've defined, whether we're in a bubble or not, can an investor do anything about it? And so first, I'll read this definition from Rob Arnott because I include it in the article, and I think it's the best definition of bubble I've seen. And we define a bubble as a circumstance in which asset prices, one, offer little chance of any positive risk premium relative to bonds or cash using any reasonable projection of expected cash flows, and two, are sustained because investors believe they can sell the asset to someone else for a higher price tomorrow with little regard for the underlying fundamentals. So you've got two things going on here. One is you can't use any sort of fundamental thing to justify what's going on. And two is people are buying things they don't even know what they are. They're just saying, I'm going to buy this because everybody else is buying it. And eventually somebody's going to buy it from me for more money. So I'm going to make money even though I don't have no idea why I'm making any money. So that's the definition of a bubble. And then the second part was, well, once you know you're in a bubble, can you do anything about it? And that was really the bigger part of the article. And that's where I was trying to make the point that even if you know you're in a bubble, it's very, very difficult for you to do anything about it. And, I use the example of the late 90s because the CAPE ratio of the S&P 500 reached an all-time high in, I think, around mid-1997. And from that period forward, so if I was looking for a bubble, I might say, all right, an all-time high in market valuation, now's the time for me to go to cash or to do something. From that period forward, we had about 3 years of 20% plus returns. So as an investor, if I had made that decision, now eventually I would have been right because eventually we had a major pullback in the market. But if I had made that decision, how am I going to sit there while my people around me are making 20% a year for 3 years and sit in my cash and not panic or make some sort of, poor decision? So I think that the gist of the article was, it's very hard to define, but to know when you're in a bubble at the time. And even if you know it, it's very hard to do anything with your portfolio. I mean, you can make small changes around the edges. You can try to invest in cheaper assets. There are some things you can do, but it's hard to do anything to time the market such that you're not, negatively impacted when the bubble pops.
Yeah, and like you and I talked about, and this is for me personally, I just have started to get a little bit more diversified across different asset classes in my own personal portfolio. And I know that that's like a kind of a timing call. It's like a risk. It's like, you're right. I mean, this thing could melt up. We could have another year, 2, 3 of above average stock returns. But for me, that's just, the decision that I made. I'm not suggesting anybody else do that, but just for me, that's, what and when we were talking about this, it's like, that's a hard thing though, because a lot of investors just don't have the patience. If the market's up another 20% and you're only up 10%, well, you feel like, you have like regret there. And, it's really tough to maintain those stances and when the market reverts higher. So.
Yeah, and you're doing it the right way, because if you are going to try to do anything in response to a bubble, like a slow, methodical move is the way. It's not, you don't want to do this all in or all out type of thing. And the other thing is you understand sort of the behavior, and that doesn't mean you can control your emotions, but you do understand that in doing this, you may lag for a period of time. So you're not likely 6 months from now, if the market's still raging on, you're not likely to abandon what you've done and go back all in. And so if you're going to do it, it's got to be small moves, I would think, and you've got to be willing to stick with it when maybe it's going against you in the short term. What was our podcast this week?
Well, before we get to that, and I'm not going to mention because I know you don't want to, but you got a really nice note from, I would say, somebody at the top of the food chain in the asset management business on the article. So kudos to you. I mean, we're always surprised to see, our articles are being read by someone.
Yeah. it's funny because you write articles for a long time and you don't get, we get feedback from people who follow us and stuff, but I've never gotten feedback from somebody like this. I mean, this is probably one of the top 5 people I've learned the most from, like in the investing business. So, it was very cool. It was very cool to get that. And, it definitely, you never know, like I said to you after we did this, you never know when you're writing these articles who's reading it. Sometimes people you never think would potentially ever read your articles are actually reading them. So that's pretty cool.
Kind of makes it all worth it when you get positive feedback like that.
Yeah, absolutely. So what was our podcast this week?
Yeah, so our podcast was about, and we've talked about this, it was about the different valuation ratios that can be used to measure a company's cheapness. So we talked about the price to book, price to earnings, price to sales, price to cash flow, enterprise value to EBITDA, and we looked at what each ratio measures, where it is derived from. So where does the denominator come from? Is it the balance sheet, income statement, cash flow statement? We looked at the strengths and weaknesses of each ratio, which that's kind of the key thing. It's like we were really trying to get at like each one of these metrics has a different strength and a different weakness. And, on Validea, a lot of these are used either within a value strategy or in some cases they're used in combination with each other, more like a value composite. And I think that's kind of where we sort of ended the podcast, was the idea of, maybe combining these, which, originates from some of Jim O'Shaughnessy's work and what works on Wall Street. And we run a strategy based on his model, the value composite model, which basically aggregates these various metrics together and then tries to look at stocks through each one and then takes like a composite score. So you're not reliant on one specific measure or the other.
Yeah, there's this is belief from some investors that value is value, and it doesn't matter how you define value. Over the long term you're going to get a similar thing, and even over the short term you're going to get a similar thing. And just looking at these ratios, they're all looking for a different thing in a company, so they end up selecting different types of companies, and they all can. You can invest in 2 value funds and you can get very, very different performance. Say, like the last year is a great example of that, because although price to book is probably the factor most people would consider the worst over the long term, if you look off the market bottom on March 26th, price to book is killing some of these other factors. And part of that is price to book has low quality sort of embedded in it. And so the fact that these low quality companies have been doing really well has driven price to book ahead of the other factors. That obviously doesn't mean price to book is a better factor than it was a year ago, because 1 year means nothing. But it just goes to show that depending on how your fund you're investing in defines value, whether they use one of these metrics, whether they use a composite of all of them, you can get really different returns. So it's just important to understand what they are and maybe the differences and the pros and cons of each one of them.
What was the article that stood out to you this week?
It was called Market Power or Moat. I think it was a CFA Institute article.
Yes. Mm-hmm.
I believe it was. Yeah, so it's interesting because this is something we deal with a lot because we run a quantitative strategy based on Warren Buffett, and he's obviously been the biggest proponent of this idea of a moat. And so we have criteria in that quantitative strategy that tries to identify companies that potentially might have a moat. But it's very, very hard to do, which is what they said here, because all of these things you might use to identify a moat, like high returns on capital, something like that, they tend to be mean reverting over time. And so certain companies will be able to sustain it over time, and that's what we're trying to find with our model. But it is very, very difficult to identify moats in advance. And this article talked about something that what they found is something better than looking for a moat might be trying to look at firms that have market power. And market power just meant there aren't very many competitors in the industry. And so when they looked at it that way, it actually performed better. And what was interesting about it is when they looked at it in 2 different ways. They looked at it from the perspective of individual stocks, and then they looked at it from the perspective of funds. And so they found from the perspective of individual stocks, firms that had a high market power actually did not outperform, but funds that invested in stocks that had high market power did outperform. And the reason is, again, there's a mean reversion element there where firms that have high market power don't necessarily sustain it forever. And so the funds, I guess, were figuring out, we're investing in these companies when they had the high market power, and the stocks themselves eventually mean reverted. And so, it didn't work over the long term. So this is like sort of the jewel of high quality company investing, is everybody wants to find these companies that have moats. And so I just thought it was interesting that they looked at it in a different way, and that they were able to find sort of a different measure that they thought was maybe better than trying to seek out high moat firms.
Very interesting article. And it kind of reminds me of, we run a strategy behind the scenes. It's not public on Validea, like called Industry Leaders, which looks across different industries and then tries to look at industries where you're seeing, and correct me if I'm wrong here, a consolidation, or over time you're seeing less and less companies, but you're seeing a higher level of profitability, which basically indicates that, the industry is basically growing, but the profits of that, business or industry are more so going to, the largest companies. So you're kind of, it quantitatively identifies like these companies with high degrees of market power. It's also something I think Kai Wu has sort of talked about to some extent in some of his work. We've had Kai in the podcast. He is the guy behind Sparkline Capital, and he writes excellent research. And I think he's written about this sort of concept a little too. So it's definitely interesting stuff.
You're right. The model we run, what it's trying to do is it's trying to find industries that are consolidating, and then it's trying to find the firms that are actually taking the market share inside those industries. So the idea is similar to this. If the industry is getting smaller, the firms inside the industry have more market power, and then let's try to find the stocks that are actually taking the most share within there, and those are sort of the ones it selects. So yeah, no, I think it is very related to the same concept. What was your article this week?
Yeah, so it was an article in Fortune written by Ben Carlson. People probably know Ben. He's a prolific writer for Ritholtz Wealth Management, but from time to time, it might be once a month or something, he will publish an article in Fortune. And the title of the article was, "This is the single biggest risk to the stock market right now." And so he starts with this idea, which we know the market's been to some extent bothered by this increase in the 10-year yield. So the 10-year bottomed at like, 0.5% in the summer, and it's been a pretty, decent sized move. It might be up around 1.6, 1.7 right now, somewhere around there. And so the market is trying to digest that. And typically, those interest rates have a lot of different implications for growth stocks and just the market in general, the risk-free rate and everything, a lot of valuations of companies. And so he sort of starts with like asking the question like, okay, so when we've seen a 1% or more increase in the 10-year, how have stocks performed when that's happened? And he goes back to 1950 and he shows that it's maybe like a dozen or so times in these periods when you had a starting yield of X and ending yield 1% or more higher. And what he shows is that in the vast majority of those periods, the market actually does very well. There's only been 2 instances where stocks were down in that type of rising rate period. But then he kind of pivots and says, what's much more important here is inflation. And when you have, going back to 1928, and he does a great job of like getting this data for decades and just crunching it and putting it in, and putting it in these articles and wrapping thoughtful insight around it. But he shows that, inflation is not good for stocks. So during periods of rising inflation, the average annual return for stocks is much lower. It's like 16.7%. When you have falling inflation, you have a 16.5% annualized return. And then when you have inflation under 3%, you have about a 15.7% annualized return. And when you have inflation over 6.3%, you have a lower than average market return. And so that's kind of the core of what he's trying to get at. He's saying rates, that in of itself, that could be just discounting higher growth. What's really more of an issue that investors need to be thinking about and concerned about is if on the backside of this, all this money that's in people's bank accounts, results in, much higher, longer term persistent inflation, because then the result of that, as we know, is the Fed will have to raise rates, and that sort of brings the whole business cycle, maybe to an end potentially, and could cause, a downturn certainly in stocks or the, slowdown in the economy. So I don't know. It's just it's good to think about. Rates and inflation are important, but I think they react, or investors in stocks react very differently to both things.
I thought one of the important things he did there is he used a rate of change. So I think there's a common misconception that, high inflation, for example, might be a problem for stocks. But what really matters more with a lot of these variables is the rate of change in the variable, but also the rate of change in the variable relative to expectations. So if you have high inflation and it's not changing, that's not as much of a problem because it's priced into the market. It's when you get these unexpected shocks in inflation, when inflation ends up growing at a rate that's greater than what the market expects it to grow at, that's where you see problems. And so that's why it's important. He didn't say, high rates of inflation are bad for the stock market. What he said is a high rate of change is bad for the stock market. And I think it's important for investors to maybe distinguish those two concepts.
Yeah, and the other thing he just sort of ends with, and then we'll wrap it up, is like, you could have a rip-roaring economy and you might have a market that doesn't do very well. It's kind of like what happened last year. You had, probably the worst fall off in GDP maybe ever since the Great Depression, and yet the market bottomed because of all the government intervention and what the Fed did and everything like that. But, it doesn't, his point here in conclusion was, it doesn't really mean, if rates are rising because of better growth expectations and an improving economy as we reopen, that doesn't automatically mean that stocks are going to go up.
Yeah, the market cares about the future. The market cares about what's going to happen, and it doesn't care about what's happening right now. It cares about what's going to happen in the future. And so, like you said, you can have a great raging economy, but if the market thinks that's going to roll over, then the market's going to start going down while the economy's still going up. So I think that's an important point to understand.
So we'll put links to all these summaries and articles and podcasts in the show notes, and we appreciate you guys watching. We'll see you next time.
Thank you.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.